No one likes paying taxes. For founders, taxes can feel scary, confusing, and expensive, especially when cash is tight and you're trying to keep the business alive. But if you want to grow, compliance is not optional. It's what banks, investors, and serious partners check first. And let's be real, understanding the nitty-gritties of every tax authority in every country you operate is hard. We've made mistakes ourselves, and we've seen strong businesses get delayed and even disqualified from funding simply because they were not tax compliant. So here are 5 common tax mistakes you should avoid at all costs when you start. One, not keeping your tax compliance certificate updated. This one can cost you time for no reason, and is such a simple thing to fix. A lot of lenders, government agencies, and even grant programs will not disburse funds if your tax compliance certificate is expired or missing, or at least they'll ask you a lot of questions. You can have the deal approved, the paperwork signed, and still get stuck because they ask you to update it last minute. It's an unnecessary mistake, so don't treat it lightly and make sure you are always up to date. Number 2, forgetting to negotiate your contracts as tax exclusive. This is one of the most painful hidden losses founders face. You quote a price, the client accepts, you deliver, then you realize the amount you agreed on was tax inclusive, meaning VAT or withholding tax comes out of your revenue. With VAT being at 15 or 20%, your margin can disappear very quickly. So make it a habit when you sign contracts, be clear whether your pricing is tax inclusive or exclusive, and make sure the contract language matches it. Number 3, trying to save money on annual returns or filings. A lot of founders delay returns because they don't want to pay an accountant or pay the government fees to file the annual returns. Or we're still small, we can wait. Yes, but penalties don't wait. And more importantly, when you need financing, due diligences will always ask you for your tax filing, your annual returns, evidence of compliance over time. So if those are missing, you look unstructured and risky, even when your business is doing well commercially. Number 4, mixing business money with your personal money. This is an extremely common mistake at the early stage. You pay your groceries from the business account, you cash out from personal expenses, you don't keep receipts. And then at the end of the month, you can't explain what is revenue, what is cost, what is salary, and what is drawings. For tax authorities, this creates confusion and mistrust. Even if you're still small, for being controlled, you cannot guess that the tax authorities will not check your books. So keep one simple discipline: separate your accounts early and always keep the receipts. Number 5, not keeping paper-backed copies of your supporting accounting and legal documents. Even when you have digital files, many audits still require physical support. If you can't produce invoices, receipts, delivery notes, contracts, payroll records, or tax payment confirmations, then you end up spending weeks trying to rebuild all your records under stress. So keep a basic physical filing system. It's not glamorous, but it can save you in an audit. Yes, paying taxes is tedious and bureaucratic, but there is no need to be scared of those tax authorities. Just be disciplined and make sure you keep your books clean. If you can afford it, invest early in a good accountant and even a tax advisor. Even if it's part-time, it will pay for itself. And if you need support finding the right experts, templates, and checklists, you can join our Tungane community that can help matching you with the right experts to navigate all those complexities. Remember, we're in this together. Let's unite to build the Africa we want.